Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 137, and in this episode we are reviewing the performance of the global markets during the 49th week of 2024, and that is from Monday the 2nd to Friday the 6th of December. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Friday the Bureau of Labor Statistics reported that job creation in the month of November rebounded from a near standstill in October as the effects of a major labor strike at Boeing and the impact of Hurricane Milton in the southeast began to recede. Nonfarm payrolls, which measures the change in the number of people employed on a monthly basis, this increased by 227,000 in November, compared with an upwardly revised number of 36,000 in October, and with the Dow Jones consensus estimate for 214,000 new jobs. Despite the increase in jobs, the unemployment rate edged higher to 4.2%, which was in line with market expectations. These jobs data is likely to give the Federal Reserve the green light to lower interest rates later this month. On Wall Street this past week, following the release of the November jobs report, which came in slightly better than expected, both the S&P 500 and the Nasdaq Composite hit new all-time highs during Friday's session. But according to investors, the market wasn't hot enough to deter the Federal Reserve from cutting interest rates later this month. For the week, the broad market S&P 500 climbed 0.96% to close at 6,090, whilst the tech-heavy Nasdaq advanced 3.34% during the week to end at 19,859, and the 30-stock Dow Jones Industrial Average slipped by 0.6% to close the week at 44,642. According to the CME's FedWatch tool, futures trading on Fed funds is signaling an 85% probability for another rate cut in 2 weeks' time. In the U.S. government bond market, the yields on U.S. Treasuries traded lower on Friday as investors digested the November jobs report that kept the door open for the Federal Reserve to deliver another rate cut later this month. Earlier this week, Fed Chairman Jerome Powell reiterated that the central bank will proceed cautiously with rate cuts given the strength of the U.S. economy. However, following the release of the jobs report, traders increased their bets for another rate cut, with the futures market pricing in about an 85% chance for a 25 basis point reduction. The yield on the benchmark 10-year Treasury bond fell by 3 basis points to close at 4.15%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note declined by about 5 basis points to settle at 4.09%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, on Thursday, the Organization of Petroleum Exporting Countries and its allies, which are jointly referred to as OPEC+, decided to delay the unwinding of production cuts by another 3 months until April 2025. OPEC Plus is responsible for about 50% of global oil production and was planning to start unwinding production cuts from October 2024, but a slowdown in global demand and rising production from other countries has forced the cartel to postpone the plan on several occasions. In response to the foregoing, the price of the global benchmark Brent crude fell more than 2% this past week to close at $71.12 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, dropped about 1% during the week to settle at $67.20 per barrel. In the precious metals market, the price of gold ticked up on Friday after the November jobs report suggested that the labor market continues to ease gradually, leaving room for the Federal Reserve to cut interest rates later this month. The prospect of further rate cuts has underpinned the rally in gold this year, as lower interest rates tend to increase the appeal of holding this non-yielding asset. Traders are now pricing in about an 85% chance for a 25 basis point rate cut at the Fed's last policy meeting for this year. In response, the price of spot gold was marginally higher by 0.2% to close the week at $2,632 per ounce. In the cryptocurrency market, the price of Bitcoin broke above the much anticipated level of $100,000 on Wednesday and continued to soar to hit an all-time high of $103,844 per Bitcoin. This move came after Donald Trump announced plans to nominate Paul Atkins, who is a cryptocurrency supporter, as chairman of the Securities and Exchange Commission. However, following some profit-taking on Thursday afternoon, the flagship cryptocurrency pulled back from this milestone but still continues to hover around this level. And according to data from Coinmetrics, the price of Bitcoin is up by more than 140% in 2024 and up by 48% since the US presidential elections, and was last seen trading at around $99,140 per coin. We now change scene to the Kenyan financial markets, And we start by looking at the outcome of the Central Bank's Monetary Policy Committee meeting that was held on Thursday, the 5th of December, and where the committee decided to lower the central bank rate from 12% to 11.25%. And for a comprehensive overview of the policy meeting, please listen to the topical issue at the tail end of this podcast. In the domestic foreign exchange market, during the past week, the Kenya shilling appreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.33, down from 129.64 that was recorded the previous week. Meanwhile, the sterling pound was priced at 164.34 and the euro was valued at 136.07. And on the regional front, one Kenya shilling was changing hands for 28.45 Ugandan shillings and 20.34 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.45. The Central Bank of Kenya has finally decided to release its firm grip on the dollar-shilling exchange rate, allowing it to fluctuate from the static rate of 129.20, where it was for about 2 months. The previous price action, where the dollar-shilling rate was stationary at 129.20, was both unrealistic and unsustainable. The central bank has previously stated that it does not have a target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should therefore stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $38 million for a total of $8.96 billion, which is equivalent to 4.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the interbank market, during the past week, the interbank market was sufficiently liquid and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this dipped by 10 basis points to 11.83%, down from 11.93% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 38.8 billion shillings, up from 23.1 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 24 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 5th of December, and the central bank received bids totaling to 42.3 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 176%. The central bank ended up accepting almost the entire amount as it took in 42.2 billion shillings, and the results of the auction were as follows. The 91-day rate declined sharply by 79 basis points to average out at 10.45%, whilst the 182-day rate plummeted by 78 basis points to level off at 10.54%, and the 364-day rate followed the trend as it fell by 52 basis points to settle at 11.96%. In the primary bond market, the first auction for the December bond issue was held on Wednesday, the 4th of December, and the central bank received bids totaling 71.3 billion shillings against an advertised amount of 25 billion shillings, representing a performance rate of about 285%. The central bank ended up accepting 53.4 billion shillings, and the results of the auction were as follows. For the first bond, that is FXD1/2023/10, with 8.2 years left to maturity, the central bank accepted 34.9 billion shillings at a weighted average rate of 14.69% compared to the bond's coupon rate at 14.15%. The second bond, which is FXD1/2018/20, with 13.3 years left to maturity, the central bank accepted 18.4 billion shillings at a weighted average rate of 15.11% compared to the bond's coupon rate at 13.20%. In the international bond market, the yields on Kenya's Eurobonds were on a downward trajectory, with the yield on the 7-year 2019 Eurobond decreasing the most by about 40 basis points as it dropped from 8.1% recorded the previous week to 7.7%. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NASI, the NSE 10, and the NSE 25 gaining by 3.3%, 3%, and 2.5% respectively, whilst the NSE 20 declined by 1.6%. This takes the year-to-date performance to gains of 32.2% for the NSE 10, 31.5% for the NSE 25, 25.3% for the NASI, and 21.4% for the NSE 20. The market's performance was mainly driven by gains recorded by large-cap stocks such as DTB Bank, Safaricom, and East African Breweries, which increased by 12.6%, 8.3%, and 3.8% respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as Bamburi Cement and KCB Group, which declined by 10.7% and 1.2% respectively. Up next is our topical issue, and this week we are reviewing the outcome of the Central Bank's Monetary Policy Committee meeting. The Monetary Policy Committee met on Thursday, the 5th of December, and reviewed the outcomes of its previous decisions that were implemented to anchor inflationary expectations and maintain exchange rate stability. The committee met against a backdrop of an improved outlook for global growth as major central banks continue to ease monetary policy in tandem with a decline in inflation. Global growth continues to recover and is projected at 3.2% in 2024, supported by strong growth in the United States. The main risk to global growth relates to the escalation of geopolitical tensions with regards to the ongoing conflicts in the Middle East and Ukraine. On the domestic front, inflation in Kenya was steady at 2.8% in November compared to 2.7% in October and remains well below the central bank's midpoint target rate of 5%. Overall inflation is expected to remain subdued in the near term, supported by lower food and energy prices. Meanwhile, the Kenyan economy slowed down in the first half of 2024 with a real gross domestic product growth of 4.8% compared to a growth of 5.5% in the first half of 2023. Kenya's current account deficit, which indicates that the country imports more than it exports, was estimated at 3.8% of the gross domestic product in the 12 months to October 2024 and is projected at 4% of the gross domestic product in 2024. The central bank's foreign exchange reserves currently stand at $8.96 billion, which is equivalent to 4.6 months of import cover and continues to provide an adequate buffer against any short-term shocks in the domestic foreign exchange market. The banking sector remains stable and resilient with strong liquidity and capital adequacy ratios as the percentage of non-performing loans stood at 16.5% in October 2024. Meanwhile, lending to the private sector was flat in the month of October as loans issued in Kenyan shillings increased marginally by just 4%, whilst loans denominated in foreign currency, which account for about 26% of the total loan book, contracted by about 12%. The ongoing implementation of the supplementary budget for the fiscal year 2024-2025 is expected to lower the fiscal deficit to 4.3% of the gross domestic product. This fiscal consolidation should help to reduce the uptake of additional debt and in the process reduce the debt to GDP ratio from the current level of 70% towards the target anchor rate of 55%. The committee observed that whilst short-term rates on government securities had declined sharply, commercial banks, on the contrary, had not responded by reducing their rates proportionately. The committee therefore requested banks to lower their lending rates in order to stimulate credit to the private sector and in the process help to drive up economic activity. The Monetary Policy Committee noted that in the near term, inflation was expected to remain below the midpoint of the central bank's target range and concluded that there was scope for further easing of monetary policy and therefore decided to lower the central bank rate from 12% to 11.25%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout, and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, your talent is the purest and most honest expression of yourself. Think about it. Thank you, and God bless.